Good afternoon, everyone. It is my pleasure to welcome you to this new episode of our webinar series on business, human rights, and the environment in Europe, Connecting the Dots. My name is Ana Duarte, and I am a research assistant at the Nova Center on Business, Human Rights, and the Environment, and a master student in Law and Management at Nova School of Law. Before we begin, I would like to inform you that this panel is being recorded, and the recording will be made available in the upcoming days. This webinar episode will be focused on corporate due diligence and sustainable finance. This topic has been gaining momentum since March 2018, when the European Commission adopted the Action Plan on Sustainable Finance, which recognized that the financial sector has a key role to play in reaching the environmental and social goals set by the EU. In particular, Action 10 of the Action Plan stated that the Commission will carry out analytical and consultative work with relevant stakeholders to assess, among other things, the possible need to require corporate boards to develop and disclose a sustainability strategy, including appropriate due diligence throughout the supply chain and measurable sustainability targets. On this basis, the European Commission commissioned a study on due diligence through the supply chains, which led to the announcement of the upcoming Directive on mandatory human rights and environmental due diligence at the EU level. And these are the developments that our brilliant panel of experts will be discussing today. We would like to thank our partners for their support in the organization of the webinar series, and in particular to the Portuguese Presidency of the Council of the European Union, the Portuguese Ombudsman Office, the British Institute of International and Comparative Law, the Teaching Business and Human Rights Forum, and the Nova for the Globe. I would also like to acknowledge Claire Bright, the director of the Nova Center on Business, Human Rights, and the Environment, who is the convener of these webinars. And I want to thank to all the distinguished guests, as well as all the team behind the scenes. It is now my pleasure to introduce our chair, Paloma Muñoz, who has worked to promote business respect for human rights around the globe for over a decade. Paloma is currently an advisor for the United Nations Working Group on Business and Human Rights UNGP 10+ project, and is senior consultant of the UN Human Rights BTEC project. In her capacities, she supports effort to develop an ambitious vision on roadmap for promoting the uptake of the UN guiding principles on business and human rights among institutional investors in the next decade, and leads work on responsible investment in digital technologies. In her capacity as steering committee member of the IE Shared Prosperity Initiative, Paloma provides strategic guidance on developing resources for companies on artificial intelligence. As advisory board member of First Peoples Worldwide, she supports effort to promote collaboration between indigenous people and investors to address the impacts of companies on indigenous communities in the United States. Prior to joining the UN, Paloma was the director of the Investor Alliance for Human Rights and a senior advisor at the Danish Institute for Human Rights. She holds a Master of International Affairs from the School of International and Public Affairs at Columbia University, and also a Bachelor in Political Science, also from the Columbia University. Paloma, thank you so much for accepting our invitation, and now the floor is yours. Thank you.
Thank you so much, Anna, and thank you to Claire and all of the organizers, and of course to all of the esteemed panelists and participants joining us today. I am really delighted to be here. As I think this conversation is absolutely necessary and certainly incredibly timely. I think we all realize that we're in a moment in time of really unparalleled global challenges, as well as compounding crises. The COVID-19 pandemic, sort of growing inequalities within countries, between countries, the climate crisis, and of course, the sort of ever rapidly evolving risks that are associated to digital technologies. Sort of in parallel to this we also see that there's a corporate culture of short-termism in financial markets, which are certainly bringing devastating consequences for people and planet. So in this really globally tumultuous time, addressing the role of business as well as finance is absolutely essential. And this is obviously because financial actors fuel economies, and therefore they have systemic influence over financial markets and the behavior of companies. So, and I'm sorry if you hear a little sound next to me. My dog is here trying to get out the door, but hopefully she'll quiet down. So as I was saying, financial institutions, including commercial banks, institutional investors, and the development finance institutions have really tremendous systemic influence to make change. They have an opportunity to really shift corporate conduct towards a path of sustainability. Just in case not everyone is aware of the relationship between sustainable finance and all of these other kind of terms that are used, for example, ESG or human rights in business, I'll flag that when we are referring to sustainability in finance, we're talking about the process by which financial institutions really take into account environmental, social, and governance considerations when it comes to their investment decisions. And when we talk about ESG, is the acronym, we obviously are also taking into account internationally recognized human rights. Now, governments around the world have begun to really recognize that financial actors play a key role in driving as well as undermining private sector sustainability. So as a result, they're increasingly seeking to activate financial actors, both their resources, but also their leverage to drive sustainable economic development. And as I think was just mentioned, the EU is really taking on a global leadership role in redefining the roles and responsibilities of financial actors by really integrating ESG considerations into the heart of the region's financial system. Needless to say, this is very positive. At the same time, key questions remain. For example, how to really practically scale sustainable finance within Europe, but also beyond. And I think crucially, how to ensure that sustainable finance is effective in driving better outcomes for people and the planet. Now, these are really concerns that are shared by the UN Working Group on Business and Human Rights, which is why the working group has launched the UNGP's 10 Plus project. And the project really prioritizes the role and the responsibilities of institutional investors to respect human rights as a key means to speed up and to scale up the corporate respect for human rights. So the goal of the project, as alluded to, is really to chart a decade of action on business and human rights through the widespread implementation of the UN Guiding Principles on Business and Human Rights. For those who aren't as familiar, perhaps, with them, the guiding principles were unanimously adopted by the UN Human Rights Council in 2011, which really makes them the globally authoritative standard of conduct for both governments and for businesses. And of course, businesses include financial institutions. When it comes to safeguarding the inherent dignity and well-being of individuals and communities. I'll briefly just mention a couple key points of the guiding principles and we'll move on to our panel. The guiding principles clarify that this responsibility to respect human rights applies to the entire spectrum of financial institutions. So that includes commercial banks, it includes institutional investors, asset management firms, pension funds, brokerage firms, insurance companies, the list goes on and on. And this responsibility also extends to all of the products and services offered by financial institutions, commercial loans, project lending, active and passive investment services, and so on. Now, to uphold this responsibility, financial institutions will need to know the risk connected to their investment activities and show how they're addressing those human rights risks. Now, how this is done will, of course, vary in practice across financial institutions, seeing as the leverage and tools of different financial institutions are really quite different from one another. That said, what does not change is that the responsibility to respect human rights must always be a core element of sustainable finance. Now, that really is why today's discussion is so important. Our esteemed panelists will help bring clarity to this space by providing an overview of recent developments, both in law and in practice, with regard to sustainable finance and corporate due diligence. So with that, I'd like to introduce our esteemed panelists, and then we will get the conversation going. First, we have Celine Tan, who is the Reader in Law of the School of Law of University of Warwick and the co-director of the Center for Law, Regulation, and Governance of the Global Economy, or GLOBE. We have Dr. Daria Davitti, who is Associate Professor at the Faculty of Law of Lund University, where she focuses on the human rights implications of refugee finance and climate finance. We have Phil Bloomer, the Executive Director of the Business and Human Rights Resource Center, which I'm sure many are familiar with. And this is a digital platform that empowers human rights advocates within civil society, within business and government. We also have Robin Brooks, who is a corporate finance lawyer with over 30 years of experience. He joined Norton Rose Fulbright as a trainee solicitor in 1980 and retired as a partner in 2018. We also have Rodrigo Marques Tavares, who is founder and president of the Granito Group, a company that advances the sustainable economy through strategic consulting, financial advisory services, and policy and research. Rodrigo is also a professor of the sustainable finance at NOVA, at the NOVA School of Business and Economics. We also have, of course, Tara Van Ho, who is lecturer in the University of Essex School of Law. She's also co-director of the Essex Business and Human Rights Project and the co-president of the Global Business and Human Rights Scholars Association. And last but not least, Tyler Gillard, head of the due diligence unit in the OECD Center for Responsible Business Conduct. So we have a packed house of really stellar panelists. And so I think we need to just get the conversation started. I want to flag a couple of housekeeping notes. First is that we're going to go through this conversation. Panelists are going to present their interventions, then we'll open up for questions. But please feel free in the meantime to use the question function at the bottom of the screen to share your questions as they come up throughout the conversation. So with that, let's get started. Phil, I'd like to start with you and really dig into sort of the rise of ESG or sustainability investing in particular. We've seen institutional investors, individually or through collective platforms, sort of engage on human rights issues since the early 1970s, but it's really only been quite recently in the last 5 years or so that we've seen sort of an exponential growth in ESG-based investing. So what's driving this trend?
Yeah, thanks very much, Paloma, and thanks also to the Nova Centre and Claire. I think let's start by celebrating the extraordinary successes of yesterday by ESG investors, both at the Exxon and Chevron annual meetings, plus simultaneously, as of course, with the Dutch court ruling on Shell. I think those three extraordinary successes illustrate the growing scale of ESG investors and their cooperation together, but also their increased assertiveness and influence in markets over time. So as you are pointing out there, Paloma, I think we've got a real sea change, particularly over the last 5 years. There's been push and pull factors on that. The pull is obviously the increased attraction of ESG investments because of their increased resilience. But I'm not going to spend a lot of time on that because I think others will also highlight that. I'm going to spend a little time looking at the push factors, because I think since the global economic crisis of 2008, really the last decade has been far from the global age of globalization. In the public mind, global finance is associated with rising inequality, precarious work, climate breakdown, rootless capital and corporations, and a systematic tax avoidance and evasion by a large number of those actors. I think there's also been that sense of the financialization of everything, including health services, education services, and even now social housing. So there's a reaction to that. There's a public loathing at the unfairness that has been created by some of those investments, the more unscrupulous end of it. Combined, I think, with the public fear that economies have no longer serve them and the financial markets no longer serve them. And this has led to that move to a rapid rise of populist reaction, led, of course, by powerful orators that we all know who've touched public fears and often offer perverse but simple solutions to the crisis. Some of those are profoundly authoritarian and anti-democratic, and most challenge the unfettered free markets and flow of capital. Now, I think most companies and financial institutions failed to identify these threats and either saw these changes as entirely irrelevant to them, or indeed have backed them unscrupulously in the hope of cuts to corporation tax, and indeed the advantages to some of them of crony capitalism. But it was left to a collection of civil society organizations, far-sighted politicians, multilateral institutions, some of which are here today, and a cluster of more responsible businesses and investors to constantly raise the alarm and to innovate at the margins to demonstrate a much more sustainable future that was possible. And now we're in a situation where political parties of the centre, left and right have seen their electorate desert them and have quickly realized that they need to begin to express a vision for economies and financial markets that deliver shared prosperity and shared security, rather than a winner takes all and a race to the bottom on workers' rights and environmental standards. I speak cautiously, of course, from Great Britain on this, but you will understand my position. This has led to a sea change, I think, in the language of diverse governments, from 40 years of deregulatory and liberal deregulatory action on financial markets to speaking much more assertively about rules to shape our economies so that they work for the majority, safeguard the vulnerable, tackle climate breakdown. That business and financial regulation needs to express the values of fairness and environmental stewardship alongside entrepreneurship and business incentives. Now, no doubt this trend has also been accelerated by the critical juncture of the pandemic, where suddenly states are seen as much more vital to our system's survival, and indeed lower paid essential workers have become, well, essential, and systematic abuse of them is no longer tolerable, which was not necessarily the case only 5 years ago. To name just a few iconic regulatory initiatives, you've gone into them already, but we've got obviously the European Union, human rights and environmental due diligence. We've got strengthening of modern slavery laws now. We've got import bans in the US on goods suspected of forced labor, Europe's green taxonomy and the Sustainable Finance Initiative. And now, crucially, with the initiative taken with the help of the OECD by Janet Yellen, of the prospective global agreement on a floor on corporate taxation, which again is fundamentally important in terms of financial markets. In summary, enlightened elements have read the public graffiti of protest that's been on the walls and are now seeking to curb some of those worst excesses. European Justice Commissioner Didier Reynders speaks of the new business model that's necessary, a transformation. And Dante Pesci of the UN Working Group warns businesses and finance that laws are coming, so you better get ready. Now, the rise of ESG is a natural response to this shift in the landscape and the regime. It expresses a major shift in the sentiment of both asset owners and asset managers regarding their risks. Risks both of their asset impact on the environment, on workers, but also clearly the risk to their assets if they are not prepared for regulatory change. Now, that's not to say that ESG is now singularly a force for good. It can be, but it's also being deployed as a profoundly dangerous fig leaf for business as usual. To give you just two quick illustrations from our own work, yesterday we released our latest Know the Chain benchmark that ranks apparel companies on their efforts to eliminate the most egregious labor abuse of forced labor in their supply chains. the largest investors in the lowest scoring 5 companies were all ESG investors. To get a little more granular, US asset managers Invesco and Vanguard are the largest investors in Prada, for instance, that scored just 5 out of 100 for its efforts on forced labor, and Foot Locker that scored just 13 out of 100. And similarly, our evidence on humanity's greatest current challenge, the fast and fair transition to clean energy, our human rights benchmark for renewable energy sector, where so much ESG investment is directed, shows renewable energy companies and investors demonstrate little or no human rights due diligence in their investments. This is something that we believe explains the profoundly worrying culture of resistance from so many indigenous nations to renewable energy projects on their land, because they now associate that with their dispossession and their nation's extinction. And finally, then, the transformatory changes face enormous opposition from massive vested interests, often represented by asset owners and companies that they own. They've benefited so greatly from the deregulation of the last 40 years, they don't want to let that go. And the inequality of wealth and power are now the greatest obstacles to tackling climate change and achieving essential social justice to achieve sustainability. We see that in the lobby in Brussels and Washington, DC, and so many other capitals right now, including against the current EU legal initiative on due diligence. But these are voices that are now heavily on the defensive. Yesterday's achievements of committed ESG investors at Chevron, at Exxon, and regarding Shell, working both with strategy and in concert with each other, illustrates the power of ESG investors now to help drive the transformation of markets in ways that will force even the most recalcitrant companies to achieve urgent sustainability through that internalization of their social and environmental costs which they've traditionally externalized as pollution and abuse of workers and communities to maximize the short-term return of shareholders. And that, I think, is now changing. Thank you very much.
Thanks so much, Phil, really for setting the stage here for where we are, and clearly very sort of succinctly elaborating on some of the main challenges that we have. I think one of the things that's very apparent from your intervention is how there really haven't been sort of many standards with which investors have sort of used to guide their responsible investment or their sustainability finance practices. So I think this is a good opportunity to sort of transition over to Tyler to kind of hear a little bit about global standards with regard to sustainable finance. The OECD has really taken on a leadership role in trying to address these challenges, the challenges that Phil just mentioned. So Tyler, could you please share with us a little bit around sort of the OECD's work around sustainable finance and also how it relates to recent developments in Europe?
Sure, thank you very much, Paloma, and also thank you to the Nova School and everybody, Claire, for organizing this event. It's a pleasure to speak. Well, I mean, first of all, I think when you think about standard on ESG investing, we have a bit of a conflict. On the one hand, actually, you have a lot of standards, but mostly they're private standards that don't actually align with global benchmarks. So where there has been a vacuum traditionally is in global authoritative government-backed standards that are developed with stakeholders and communities and business hand in hand. Now, you know, the financial institutions have the same responsibilities for responsible business conduct, to respect human rights, to respect the environment, as any other business in the real economy. And I think we, you know, particularly at the OECD, our work on responsible business conduct is really anchored in implementing the OECD guidelines for multinational enterprises. This is a broad code of conduct that dates back to the 70s and has been revised numerous times, including in 2011 to include a human rights chapter aligned with the UN guiding principles, but also covers environment, anti-corruption, anti-bribery, taxation, etc. And I think before the last update of the OECD guidelines in 2011, before the UN guiding principles, there was really this sort of financial institution exceptionalism around these standards about, oh, that they're a bit too complex, it's too difficult. I think we have moved beyond that now. And so we should not be designing policy or approaches that sort of exempt financial institutions. And in fact, we need to double down on financial institution responsibilities because they are the link to every sector in the economy. I mean, they are a path gateway to commodities, high risk commodities, to construction, to any high risk sector. You know, they need finance, they need banking, they need to raise capital. So for that reason, they're a massive choke point in how do we drive change globally, I think, as Phil rightly said. So, you know, we at the OECD have the framework, the OECD guidelines for multinational enterprises, and all the governments that have committed to that, that's 50 governments to date, have also committed to set up what are called national contact points, which are basically national bodies charged with, you know, facilitating and promoting guidelines, but also hearing complaints. Now, why have we really focused on financial institutions? And I'll talk about what we've done in a moment. Well, partially it's because there's been a huge rise in complaints against financial institutions since 2011. So if you look at the data of the number of complaints that have been brought in the last 20 years, roughly around 600 complaints in 20 years, pre-2011, only 1% of those complaints focus on financial institutions. And that was largely to do with how financial institutions were managing their own employees. That because before 2011, nobody really knew how do these standards apply to supply chains, to business relationships, to more complex products and services. You know, we get that companies need to make sure their employees' like rights are respected, you know, in their own operations. But when you talk about, you know, complex products and dealing with counterparties, what is the different roles? I think that's only been clarified since 2011 with the help of the Ruggie framework and our alignment there. Since 2011, almost 20% of NCP cases now have focused on financial institutions. So that's 1 in 5 cases dealing with a whole wide range of issues around the role of pension funds and sovereign wealth funds investing in equity and debt and as a minority shareholder, all the way through to project finance, to nominee shareholders, a whole range of issues. And what that has meant essentially is that, you know, financial institutions felt that we needed to clarify how these broad code of conduct applied to them. And what we've learned, and I'll tell you where we are in the process, what we learned is 2 things. One is the broad brushstrokes of what due diligence means applies similarly to everybody. So that means, you know, setting policies, undertaking robust risk assessments, engaging stakeholders effectively, prioritizing, using leverage to affect change, tracking progress, publicly reporting, and remedying harms that companies cause or contributed to. That's the broad framework. But when you dig a little deeper, we realize that, as you said, Paloma, you know, every single financial service kind of is a bit different and requires a little bit more nuance in what this means. So since 2015, we have embarked on setting a range of standards for different types of financial services to really, let's say, breathe life into the OECD guidelines and the UN guiding principles on what this means. Because as you say, sustainable finance is not, we're not all talking about the same thing. We have equity investment, we have asset managers and asset owners investing in equity and investing in fixed assets, fixed income assets like debt. So you have the whole kind of investment value chain. And even in that value chain, you have rating agencies, you have advisors, you have exchanges, you have proxy voters, you have a whole range of actors that enable that investment, that channeling of finance from the public into companies. But that's not the only way that companies raise money, you know. And in fact, our data shows that actually post, maybe surprisingly, but past the 2008 financial crisis, since 2010, debt finance has become by far the largest source of finance for companies, by far. In part, that's mostly due to emerging markets like China, who are heavily leveraged. But nonetheless, corporate lending and the role of commercial and financial and investment banks in underwriting debt and in underwriting securities, but also just in opening general corporate lending, as well as providing project and asset finance. Those are becoming much larger shares. And I would say amongst that, corporate lending is the biggest. And that's the often overlooked piece. There's a lot of talk about the role of asset managers and asset owners, which is great because they have rights and responsibilities. As an owner, you should exercise your rights on those companies. But if you look at the figures, corporate lending is actually where companies are raising more and more capital. And there's really a lack of understanding of what due diligence means. So if I'm a bank and I'm opening up a general loan for a corporate counterparty that is operating in 40 countries, what does due diligence look like for them? Now, that's obviously very different than if I'm providing finance for a specific project, So at the OECD, we have developed a due diligence framework for the investment side, which applies to asset owners and asset managers. And that was published in 2017. And what we see there is that even the due diligence strategy for an active investor is different than a passive investor. And what I mean is that an investor that actively is picking the stocks in their portfolio, they have a lot more opportunity to actually screen all those specific stocks and the underlying companies before they actually invest in them. And then, of course, monitor them on the ongoing basis. Passive investors are generally, their whole strategy is to track the market. It's to not pick specific companies. It's just to track the market. And so they rely on index providers or a service provider to help divide an index that will track the market. But they still have an important role in ensuring that index provider does the screening that is necessary. And there's still a real gap missing. We don't see that asset owners and managers are really expecting the index providers to really do effective due diligence on underlying companies and devise indexes that reflect not only the market, but the responsible market. And there you see all the data around ESG investing. I know we're going to get into that, but what is ESG investing, we realize means very different things to a lot of different people. And I think explains some of why those bad performers that we've heard from Phil, because a lot of it might be just focusing on exclusion. Actually, probably 50% of ESG investing is purely, we just exclude the most harmful stuff like cluster munitions, perhaps tobacco, but the rest is just fair game. So I think within that investment piece, there's still some major gaps, but overall, we feel like the momentum is building, there's clarity building, there's regulation coming on the books, and I think there's a good sort of trajectory. Now, when you look to banks, clearly banks have been regulated since the financial crisis, but I think this is an area where there is still quite a bit of lacking in regulation for banks, and that's particularly around corporate lending and their responsibilities when underwriting securities and debt. And again, the due diligence, we issued due diligence guidance in 2019 for banks for exactly that, corporate lending and underwriting securities. And there we saw that there was really quite a wide variety of approaches, and that for a bank, when providing a loan to a company that is operating in 40 countries, it's very difficult for them to hone in and do a risk assessment on every single entity within the parent group and every single operation. In fact, it might not be possible. So their systems for prioritizing, for onboarding, and building in screening into their creditworthiness checks are really fundamental. But another part that's really fundamental, which is completely lacking, is the ongoing monitoring. And that often what we see in the finance industry is environmental social due diligence is really considered ex ante. But once the funds leave, it's sort of, we're done. And I think that is where we need a culture shift. That the similar ways that banks will have provisions for default on loans, they need to start to build in provisions for default that might mean because you're not performing and meeting these kinds of standards. Finally, we're now just finalizing a new standard related to project and asset finance. So that's really looking at kind of the traditional, what you think of the Equator principles already sort of apply to. A bank is financing the building of a dam or the securing of a new plantation, etc. There we are building on quite an well-established practice because of the Equator principles, because of IFC performance standards. But what we've noticed is that there are some significant gaps between that and what we now understand as best practice in line with the UN guiding principles and OECD guidelines. And those gaps namely are around how do banks engage stakeholders, affected stakeholders in the decision-making and in their due diligence, whether or not they actually have a grievance mechanism in place to hear grievances of affected communities, and most importantly, the actually processes to provide a remedy when banks cause or contribute. Our research, and I should say all of these standards are negotiated in a multi-stakeholder environment. I always joke that I started off this work with a full head of hair, but those negotiations left me where I am today. But the power of that is that they're negotiated in multi-stakeholder environment, then they're adopted by 50 governments. So they have some authority. And what we've found is that project and asset finance banks are much more likely and closer to the contribution scenario, where they, if something happens, they're going to be on the hook for providing a remedy. When you look at general corporate lending, they're much further away because that sort of causal link in a way is not really as well established. I think I'll just sort of end it there because I think you have some other speakers to go through. But just to say that there are still some massive blind spots, I think, in the sustainable finance world. And if you look at the source of finance from corporates, actually corporate lending is the place where we need to be looking at. Thanks.
Thanks so much, Tyler. Really, the OECD has spearheaded very important work, and I think you illustrate how important it is for financial actors to tailor their approaches depending on their various sort of leverage tools, et cetera. The same for obviously governments or civil society seeking to engage financial actors. It's incredibly important to recognize some of those differences to be effective. A question has just come up from the audience saying, how can ESG related risks and relevant reputation be quantified? And how to judge how significant these risks are among other factors. And I think this is actually a great question to transition to Rodrigo, because I think one of the big questions, I think, especially within the financial sector is, well, okay, what does this actually mean for financial actors in terms of their business, which is to make financial returns, to make profit? So Rodrigo, to you, I mean, what is, how profitable is sustainable finance, if at all?
Paloma, that's the holy grail of sustainable finance. Thank you, Claire, for the kind invitation, the Nova Law School, and thank you, Paloma, for the mediation. There's a lot of questioning around the profitability of sustainable finance. And actually, there is no yes or no answer for this. Just like I would not be able to say whether private equity or venture capital is profitable, because it totally depends. It depends on geography, it depends on asset classes, it depends on investment styles, it depends on time frames, it depends on whether you are investing in companies at the very beginning of their ESG journey or when they are at the plateau of their sustainability journey. So it depends. But I would like to say two things. Number one is just trying to illustrate and encapsulate this whole discussion on whether sustainable finance is profitable or not. Just this year, there was a new meta-analysis from the New York University and the Rockefeller Asset Management, which aggregated findings from more than 1,000 research papers authored between 2015 and 2020. And this meta-study concluded that for investment studies, 59% of them showed that ESG-related investments have similar or better performance relative to conventional investment approaches, so non-ESG approaches, while only, I believe it was 14%, found negative correlations between ESG investments and performance. Another illustration that I could make is if we compare ESG indices with non-ESG indices, and I'm actually just looking at them right now. So if we compare baskets of stocks with high pedigree on ESG relative to baskets of stocks with no ESG credentials, if you compare, for example, in the US, FTSE with FTSE for Good. In emerging markets, if we compare MSCI emerging markets with MSCI ESG leaders. So if we compare comparable benchmarks, we're going to realize that in most situations, the performance of indices which bring together ESG companies is better. Just very quick example, if I compare MSCI Europe with the comparable ESG index in Europe, in 3 years, the performance is 3.48% higher, and risk exposure is also much lower. So I don't have a precise answer for that. I believe no one does. It totally depends on the approach. There is an inclination to believe in academia, and the studies are about to demonstrate there are strong correlations between ESG and financial performance, but we need more research.
Perfect. And so just on that, what do you see as some of the kind of main challenges or threats right now in terms of sustainable finance?
Oh, there are a few worth mentioning. I would allude to 1, 2, 3, 4 of them. The first one is data. Data comes up over and over again. There's a reason why data is problematic within the frame of sustainable finance. There are more than 30 sustainability disclosure frameworks. As a comparison, if a company wants to report its financial data, there are only 2 disclosure frameworks, GAAP and GAAP in the US and IFRS in the rest of the world. But if a company wishes to disclose sustainability data, there are more than 30 different frameworks. At the same time, there are around 100 ESG and impact rating agencies. Again, if we compare these with credit worthiness agencies, there are only three major ones: Moody's, Standard & Poor's, and Fitch. But for ESG and impact data, we have more than 100. And this leads to inconsistencies in data collection, data analysis, data reporting. So data is a problem. Problem number 2, or challenge number 2, is materiality, assessing materiality. We all know that not all ESG issues matter equally. The relevance of ESG issues, ESG considerations, varies according to industry, company by company, etc. And ESG asset managers, they still lack robust skills to identify the most material ESG indicators. The third challenge could be lack of products. So public markets are fairly well covered in terms of product offering, but options are still lacking for high-yield investment-grade debt, and options are still lacking for some alternative products. There are not a lot of hedge funds, ESG hedge funds, for example, and private equity and venture capital funds. Most of them are still not ESG. So sustainable investments would also benefit from the development of a fully fledged derivatives market, which does not exist yet. So it's not necessarily true, and we work with capital markets on a daily basis. It's not necessarily true that there is a wide range of impeccable, impressive, high quality ESG products in all geographies, in all asset classes, exposed to all sorts of risks. That is not necessarily true. And the fourth challenge, it's probably the most problematic one. It's the whole issue of greenwashing. Unfortunately, it is common for asset managers to rebrand funds, to rebrand products for fundraising or for marketing purposes. And greenwashing might be involuntary too. Sometimes it's not driven, sometimes it's involuntary. And this results from the fact that there is no global standard yet and no certification scheme on ESG. So funds can call themselves whatever they wish. If I'm a fund manager in Brazil, in Portugal, in New York, or whatever, if I'm a fund manager, I can just raise my hand and say that my fund is an ESG fund, it's a responsible fund or a sustainable fund. There are very few guidelines on that. So greenwashing is problematic. Actually, there is either 2019 or 2020 study by the 2 Degrees Investment Initiative, which found that 85% of all thematic funds, specifically sustainability theme funds, have misleading marketing. So I would say that the sustainable finance market is scaling up, it's mainstreaming, it's maturing, it's consolidating. Probably in 10 years, we would not be talking about sustainable finance because it's going to be fully embedded into risk assessment strategies, profit-seeking strategies. But while we are still talking about sustainable finance, I think we have to be cautious about the colossal impact of, and the colossal size of sustainable finance. There are still some challenges that we need to overcome.
Great. So that's very helpful. I think, some people are asking questions around how to incentivize improved data, for example, disclosure by companies. I'm just curious if you could share a little bit about, your insights with regard to any developments in this area, whether it's in relation to the British Standards Institute, which I know that you work on, and the ISO initiative. If you could share a little bit about that.
So on data, on disclosures, yes, there is a new upcoming initiative from the IFRS, which is the leading financial framework disclosure organization, and hopefully soon, by next year, we're going to have only one way of disclosing ESG data, believing that the IFRS will expand its mandate to cover ESG issues as well. On the British standard, a little bit of context. So I totally agree with Tyler. In the sustainable finance field, we have moved from an initial phase about a decade ago or so when we start looking at ESG issues, where 10 years ago, there were virtually no guidelines or schemes on financial sustainability practices. And now we have moved to a phase where there are too many. There is a cacophony, a pollution of standards, principles, disclosure frameworks, guidelines, codes, etc. Just a few examples. There are plenty of guidelines on terminology, from the Investment Association Responsible Investment Framework to the GSII definitions. So if you want to know the difference between ESG, mission-aligned investment, impact investing, responsible investments, sustainable investments, there are plenty of guidelines determining what the definitions are. The problem is there are too many guidelines and the terminology is not coincident. Does not necessarily overlap. There are too many guidelines on ESG principles. For example, if I'm a fund manager, if I want to comply with general best practices, there are plenty of ESG guidelines. The UK Stewardship Code, for example, the forthcoming FCA principles, there are tens of them. There are also several taxonomies. In Europe, we might believe that there is only one important taxonomy, the European Union's taxonomy on sustainable activities. But in Mexico, there is a taxonomy created by the Association of Mexican Banks. In China, there is something called the SDGs Finance Taxonomy. In South Africa, there is another taxonomy. In Singapore, there is another taxonomy. Again, there is overlap in terms of taxonomies. There is also a range of guidelines on disclosures. There is the SFDR and other guidelines and regulations on companies' disclosures. So there is a need to streamline, to merge, to find synergies between the different guidelines. And there is a need to find a global and a prescriptive standard. So what happened was the British government, together with the International Standardization Organization, ISO, together with the British Standards Institute, the BSI, they have recently joined forces to overcome or tackle greenwashing and to come up with the first classification system for responsible and sustainable investment funds. So it is important to mention, Paloma, that the standard, this new standard coming from the ISO family, this new standard is prescriptive. The standard is rules-based. It's not principle-based, it's prescriptive. And the basic difference is that the new standard establishes minimum provisions that shall be complied with. It prescribes features a fund must have in order to comply with a responsible or sustainable investment management system. So in other words, the standard establishes prerequisites that fund managers globally need to fulfill to be able to call their funds either responsible investment funds or sustainable investment funds. And once the standard is out there, it will provide reassurance to institutional retail investors regarding the funds in which they are investing. Let me underline that the new standard covers all asset classes: private equity, venture capital, equities, fixed income, real estate, infrastructure, hedge funds, etc. The standard covers passive and active strategies, and the standard covers both responsible and sustainable investment practices. In terms of time frame, and I'll just conclude here, so the process to launch a new global standard is very ritualistic, it's very formal, and it's a collective exercise. Many players are involved. I have submitted the first draft about a month ago. It's a 60 or 70 pages long draft. I need to submit the second draft next week. Then it will be assessed by a steering committee. It will be subject to public consultation. We are expecting around 200 or 300 financial players and international organizations to come in and provide their insights on the standard. It will be mentioned, not launched, it will be mentioned at COP26 by the British government. And then it is expected to be launched in 2021, late 2021 or early 2022. So when the ISO family finally has a global standard, then the finance committee will have available a tool, an instrument to guide them on whether their funds are responsible or whether their funds are sustainable or whether their funds are not related to ESG at all. And once we have that organization, once we have that tidiness in the sustainable finance field, then I believe that we will be ready to further consolidate the sustainable finance market.
Excellent. I'm sure that you have quite a few people on this panel, but also joining us for this webinar who would love to participate in that consultation. So we really look forward to that. So I think, you really highlighted quite a few challenges in the current sort of ESG investment landscape. And I think one of those challenges, certainly with regard to data and the approach that investors are taking to ESG, is perhaps slightly siloed approaches to engaging on environmental, social, or governance issues, right? And so I think, kind of jumping over to the EU context, the EU taxonomy process, Daria, I'd love to sort of ask you a little bit about, to what extent does the current EU process seek to kind of bridge these ESG silos in order to kind of promote coherent action when it comes to financial sort of investment in people and planet?
Thank you, Paloma. And so thanks again, Claire, and for the invitation and for the opportunity to be in this panel. So it's a very good question, Paloma, and I'm glad I'm coming straight after Rodrigo, because I think what I can, so through the research that I'm doing with my colleagues on just transition and on the European Green Deal, what perhaps I can show is how the various regulations and taxonomy and delegated acts and everything that is coming out like very rapidly over the last few weeks really is, if anything, exacerbating some of the challenges that Rodrigo is talking about rather than solving them, and certainly not solving the silos issue that you're talking about, Paloma. So I don't want to be the Johnny Raincloud of the situation, but I think it's important that we go into details of what is really happening so that we have a better understanding of how we might try and improve it and how we might try and avoid problems in the very near future. So to start with, it's important to think, just to kind of contextualize, that if we want to be on path towards the 1.5 degrees warming, so what the world needs to do is to decrease fossil fuel production by 6% every year. Yeah, and this is by 2020, in the period 2020-2030. But what is happening at the moment, and unfortunately the European Green Deal is not improving on that, is that governments are planning to increase by 2% every year, right? And so this would lead basically by 2030 to more than double of what we need to be actually on track for a consistent limitation of warming to 1.5%. And so why am I saying this? I'm saying this because, so this is actually not my research, but the Production Gap 2020 report. So this we knew already last year. And but what we see is the governments continue to direct COVID-19 recovery packages and stimulus, including the EU, to fossil fuels more than towards clean energy. And so on the 21st of April 2021, the EU has presented the April package for EU sustainable finance, which has this aim of reorienting investment towards sustainable economic activities. And key to this, of course, has been mentioned today already, is the EU taxonomy, right? And in particular, so what was launched, so the taxonomy adopted before, but what was launched on the 21st of April is the Climate Delegated Act. And so the Climate Delegated Act is important because it includes the screening criteria, which will allow us to see which activities can be selected as sustainable in terms of climate change mitigation, which is in Annex 1, and climate change adaptation, which is in Annex 2. Now, Climate Earth and also many other organizations have already been very clear about some of the problems that they had detected at the beginning when there were drafts, and now this have been actually exacerbated in the actual Delegated Act that has been published in April. Because what we see is there are three main problems really that are not going to make life much easier for the financial sector or for corporations when it comes to disclose, if we think in terms of climate change reduction or limitation. Or if we talk in terms of human rights, let alone protection. So the three problems are really that natural gas is considered a transitional activity, and that bioenergy and forestry are considered sustainable activities. And this is obviously very problematic if we think of the impact that this is going to have in terms of reduce or not reducing greenhouse gas emissions. And so what we see, despite not only civil society, but only scientists had been very vocal about this, that the risk here is that we're going to lock in fossil fuel really for the next 10 to 30 years. And this is extremely problematic when it comes to the environment, as we know, but it's also extremely problematic when it comes to the protection of human rights, in particular, of course, the right to a healthy environment, but not only that, as we know. So talking as an international lawyer, this is extremely problematic because what we're going to have so we talk very much today about how the EU is taking the lead. The EU should be taking the lead, but has really seemed to have missed an opportunity to take the lead in a proper way, especially if we consider the outcome of the case against Shell yesterday. We see that actually what the EU is locking in at the moment is not very progressive. So if we think from a legal perspective, also is the difficulty that this is gonna create in the longer term. So I'm not going to go into the details of biomass and so bioenergy and forestry. But this is, of course, just in a nutshell to let you know, this is the result of a lot of lobbying that has been going on by the member states. And so it's interesting because if we talk about what is a just transition, of course, a just transition has to take into consideration the phasing out of certain sectors, but that is possible without locking in continuous reliability on fossil fuels, which seems to be what we are on track of doing. And why is this relevant for the financial sector? So that I explained to you that I haven't gone completely off topic. It's relevant because the screening criteria are going to be of fundamental importance for the Corporate Sustainability Reporting Directive, right? So what companies are going to be reported on is linked to this screening criteria, directly linked to this screening criteria. And in turn, under the Sustainable Financial Disclosure Regulations, what the financial sector and the various financial institutions are going to be taking this data that Rodrigo was talking about are going to be strictly linked to all this. So there is basically in this very complex infrastructure that the EU is creating, there is a red thread, but it's a red thread that is a red thread for non-protection, really, if I can say that. Because so what we see also with the corporate sustainability reporting directive is we see that there is this difference between limited and reasonable assurance when it comes to audit requirements. And at the moment, in the proposal at least, the EU is settling for limited assurance, which is not good, because limited assurance means that there is not really a requirement to let's say simply to report in much detail, but it can be a much less detailed type of audit that is being done. And so, of course, yeah, the EU is taking the lead in setting the threshold, but it's setting the threshold really, really low, even lower than some of the ESG that we see at the moment. And this is, of course, very, very problematic. And as a consequence, this also, so something that you need to consider is when it comes to the Sustainable Finance Disclosure Regulation is, for instance, the bonds are not considered, and the issuer of bonds are not considered financial market participants. And this has huge consequences, of course, if we think of green bonds, if we think of blue bonds, if we think of how climate finance really is being pushed and how it's going to be completely disregarded in this. And so where do we fall back? We go back to what Rodrigo was saying, to all these millions of different regulations and criteria and standards and benchmarks that contradict each other. And so the outcome of this is that really when it comes to greenwashing, the situation is not going to be tackled really efficiently, unfortunately. And finally, this of course has a direct impact also on the mandatory due diligence directive and how that is gonna be affected, because of course what the directive is going to be able to capture once it's accepted, it's only what is going to be reported upon and what is going to be regulated based on the taxonomy. So all this, it's strictly connected and strictly interlinked. And if we fail to do it properly now, really we have missed the opportunity. And of course, this it's important to say that the Delegated Act can be amended. So there is a possibility to amend the Delegated Act, but why failing in the first place? Why failing in the first place and not being able to learn from what we've seen so far, and not to be able to actually insert those protection, those human rights protection, those environmental protection that we know by science, and we know already by some of the legal outcomes that we see, like yesterday, or that we see also in the boards. Why are we not taking that on board, and why are we letting this slip already? So I think I'll leave it here, and if there are questions, then maybe I can take them after. Thanks.
Great, thank you so much, Daria. I think, clearly one of the issues is coherence between ESG action amongst financial institutions, but also amongst governments, right, and regional governments. And so how do the different sort of directives as well as regulations speak to each other, contradict each other, undermine each other, is a really important point. And I just want to kind of quickly go back to Phil, because Phil, you mentioned just transition in your opening comments, and I'd like to hear from you a little bit about what, from a civil society perspective, are your expectations when it comes to sort of just transition, both in sort of regulatory standards, but also in terms of the financial, of the conduct of financial institutions.
Yeah. Thanks. I'll be brief because there's a number of other speakers. Firstly, just to say, the just transition is about a very substantial supply chain, from the transition minerals that need to be mined, things like copper, cobalt, lithium, manganese, zinc, through to then the manufacture. And we've got issues there in terms of Xinjiang and all the photovoltaics, for instance, but also in other areas, in terms of workers' rights. And then we've got the installation, where we're seeing a large number of land grabs, particularly against indigenous and other rural communities, often feeling that this is their last land and therefore the extinction of their nations, through to then, of course, the end users of the electricity and their responsibilities for looking down their supply chain. And again, corporates are major users of electricity, as we know. So there's that whole supply chain to be looked at. And finances, of course, as Tyler and Rodrigo are pointing out, finance is involved in each of those pieces of that supply chain. So investors play a pivotal role in this, a pivotal role in insisting that if we're going to get a fast transition, is going to have some semblance of fairness. Otherwise, we will get the equal and opposite reaction and the suspensions. So the way finance asks questions of those companies is going to be critical. I'm not going to go into detail. Half of the 100 or so companies that we surveyed a year ago really demonstrate no no basic human rights commitments. Only 5 met 4 basic human rights criteria. 5 out of 100 met basic human rights criteria. So we've got to get investors really insisting that they are going to only invest in those that actually insist that that the transition is going to be fair and not be disrupted by suspensions through protest, etc. So there's the 4 key questions, which again Tyler has already mentioned. But does the company have a human rights commitment? Does the company have a due diligence process worthy of its name? Does it have a grievance procedure worthy of its name? And is it insisting on similar standards through its supply chains? The other key element from our point of view is that ESG investors, as we've seen just yesterday with this extraordinary thing that we keep celebrating, these achievements we keep celebrating, is leverage. The leverage must be a fundamental part of the industry's of ESG approach, working with PRI, with ICCR, with the international, with the Investor Alliance for Human Rights, Paloma, that you know very well because you built it, and all these other elements, making sure that there is, as Daria was saying, and Rodrigo, that incredibly important standardization, use of the international standards, the harmonization of those standards, a high quality of level playing field, insisting on that with the regulators, and ensuring that green taxonomy does not mean greenwashing, as Daria just pointed out.
Perfect. Thank you so much. I want to make a little pivot to a completely different actor within this ecosystem. We've been talking a lot about institutional investors, asset owners and managers, to some extent banks, but really want to now transition to development finance, which sort of unlike these other sectors is really designed to, finance the realization of sustainable development, have positive outcomes for people and environment. And so, I think increasingly, as I sort of alluded to at the beginning, governments are also realizing or going to the private sector, including financial institutions, to help finance development goals, including the realization of the Sustainable Development Goals. So, Celine, I'd love to get your thoughts now on what's happening in this space when it comes to the discussion today. To what extent are these activities, being done with corporate human rights due diligence in mind, and to what extent are they truly sustainable? Over to you.
Thank you, Paloma, and thank you for inviting me here, Claire and everyone at Nova. And it was really lovely to engage with everybody and to listen to all the contributions before me. So yes, I think, Paloma, you're right. The development sphere is, I think it's happening in tandem to the kind of discussions around the sort of endogenous development of what I call sustainable development investment markets, so the sort of SDI markets, or some people call it sustainable finance markets, or socially responsible SRI investment markets, right? And I think a huge shift that we're witnessing, certainly within the sort of international development finance arena, is the shift away from development financiers as direct funders of development projects and programs. So, where you have the World Bank or the regional development banks directly funding projects in the past. Now there's been a kind of a shift in sort of their raison d'etre in terms of the movement from being funders of development projects to brokers of development financing. And what I mean by brokers of development finance, and I think some of our contributors know where I'm going with this, is that the development financiers, multilateral development bank, bilateral development aid agencies, even the OECD kind of like narratives around this, is to use official sector financing to leverage or to mobilize or to incentivize private financing, including financing from financial markets. And the narrative is one of de-risking the private investments, and we've heard a little bit about that earlier on, which basically means, providing financial or regulatory incentives to encourage financial markets, financial investors to move into traditionally public sector areas, SDG sectors, to provide that financing, right? So a lot of development finance is going not directly to fund projects, but actually to improve the risk return profile of projects or programs in order to incentivize or so-called catalyze private investments. Now, this is problematic, certainly from my perspective, because as you know, private official sector financing is already limited in a lot of countries today. I'm based in the UK, and the UK government has actually suspended its 0.5 GNI aid target with to 0.5 of GNI ring fence aid budget, and with that has come quite significant cuts to public services in developing countries. But within that, there is also an understanding that the money that goes to the private sector arm, which is the CDC group, would be kind of protected, and that would, you know, so the focus has been on the mobilization. I'm not just saying it about the UK, but it's happening in the US as well with the new development finance institution there, discussions in the OECD and within the UN. All right. A lot of this movement has been about using whatever limited aid money there is, not to directly fund, but to mobilize private capital. And I think this is slightly problematic for all the concerns that we were talking about earlier in terms of whether or not the financial markets are adequately able or effective to be able to deliver that financing. So that's an issue there. So, and I have a problem with the whole notion of de-risking, because the whole narrative of de-risking, certainly within the international development finance community at the moment, is about using money, financial incentives and regulatory incentives to de-risk private sector. There is no conversation or no parallel conversation about de-risking communities. So, you know, alleviating the risks to the communities. And there's very little or absolutely no discussion about what this shift actually means for developing countries, for communities at the very sharp end of, you know, the transition that we need to see. So there are some issues that I'd like to explore here, but I think one of the things I want to raise as well here is the issue of sustainability of financial markets as a source of development finance. I mean, there's a lot of rhetoric around the promise of financial markets as sort of source of development finance, but there's not enough conversation around the risks of using financial markets, and we've seen evidence of that certainly in the last 18 months about how, you know, there certainly at the start of the COVID pandemic, you saw a massive outflow of finance from emerging markets, just like that. Okay, capital flowing out of development of emerging markets as a consequence of investor sentiment or, you know, perceptions of risk. And so with that capital flight comes a problem with, you know, the countries that are at the sharp end not having to deal with this, you know, outflow, but also having to deal with the unsustainability. And what that means for countries is that for the most part, a lot of developing countries can't plan, because let's say you have, you know, a loan agreement, right, with, you know, when multilateral development bank, you know, that's going to be there for 10 to 25 years. You know, there's a stability there. Your reliance, that shift from that loan from an official sector financier to financial markets means you haven't got that sustainability, because you know, you're subjected to this kind of unstable capital flows. And I think that's just really, really problematic. And we go back to this notion of, you know, financial markets as source of financing. What we have at the moment is what Csr Regulated calls blueprinting, right? You use a template that works for financial markets and financial returns, financial markets, and apply them to a completely new market, which is so-called the SDG market, right? you use the same instruments. Rodrigo mentioned, let's move into derivatives, for example, for to develop these new financial instruments. They're not really developing new financial instruments. You're using existing financial instruments, which are already problematic in its current use, adapt them to financing, very fundamental social, environmental goods and services with very little safeguards for communities. And I think then you're creating real problems that aren't necessarily being solved by the private governance regimes that were talked about earlier. And I don't want to go into that because I think Phil and Tyler and to a certain extent of Rodrigo and also Daria have actually mentioned, that a lot of the problems with the current private governance regimes and even, the kind of official taxonomies that have come up. So there are really significant problems about, that sustainability aspect and stability of financial markets, particularly when you then also add on top of that the diversification of the creditor base for a lot of countries who are not in a position to deal with that, because you also have the other side of the coin in terms of financial markets. We've got regulatory gaps in the financial markets as it is, due to not having sufficient controls on the inflows and outflows of capital from developing countries. The other side of it is also we don't have an international sovereign debt restructuring mechanism that actually works. So you've got a lot of countries now with significant amount of debt not being able to restructure it. The G20 initiatives for sovereign debt restructuring have not a single private investor has yet to offer debt relief to the countries that are heavily indebted at the moment as a result or compounded by the coronavirus pandemic. Okay, so when you have a situation that international financial regulatory systems and the sovereign debt financing legal and regulatory architecture does not support what happens afterwards, the transition to financial markets as the source of financing, it really now looks unsustainable and unstable. So we have a real problem, I think, that if we're constantly moving towards using finance as the alternative to official sector financing, we haven't got there yet in terms of regulation of financial flows. And I just want to raise one more thing before I stop, is the issue with, I think we have a real issue with policy space as well. I think that moving away from official sector finance to a diverse and dispersed creditor base actually limits countries and community engagement in determining development and environmental pathways, because you can't, if a country is then faced with then having to have fragmented creditors that they have to deal with, and certainly now, if you have label bonds, with that comes with the so-called conditionalities. I know they don't call them conditionalities, but use of proceeds, the delimiting of what you can use that kind of bond issuance for. These are in effect conditionalities, and they're fragmented. They're not designed by countries, contrary to some of the commitments that donor countries have made in terms of ownership, national ownership and participation of development plans. You haven't got that, because once you go into the financial markets, the financial actors, the investors, determine what you can use that money for. And I think this is really significant and really constraining, and certainly something that we, particularly all of us here who are interested in human rights and sustainable development, really need to think about very, very seriously. Thank you.
Celine, thanks so much. There's so much there. I think, what we'll do is transition to Tara. Tara, I'd love to get your thoughts on, taking a human rights-based approach to all of these issues, to finance, because I think so many of the issues that Celine just raised very much reflect a misalignment with that. So your reflections on that, over to you.
Thanks, Paloma. And thanks, Claire, as well as everyone at NOVA for allowing me to be a part of this conversation. I'm going to try to help Paloma and Claire here by reminding people that if you have questions for us, to use the Q&A portion instead of the chat function, because I don't know, maybe I'm just the incompetent one in this group, but I can't follow all of the chat and all of the Q&A. So if you use the Q&A we'll be able to follow that a little bit better. When we're talking about the responsibility for finance, I think there's a few things that we need to make sure that we cover. The first is that there is a difference between what we have in terms of expectations of businesses and what we have in terms of expectations of state actors. So by state actors, I mean your pension funds, your investors, your state-owned enterprises, your sovereign wealth funds. They have not just the responsibilities that other corporations have, but they also have the responsibility of states. So that means that they have a responsibility to ensure that what they are doing respects human rights, but it also protects human rights and it fulfills human rights. That's a much broader set of responsibilities than what we're talking about when it comes to businesses. I'm not going to go into all of the responsibilities that arise because of their responsibilities for protecting and fulfilling human rights. I'm going to stick to the respect responsibilities because those address the responsibilities of both the state actors and private actors. But I think it's really important that we remember that there are more obligations of the states. The obligations of states also are to adopt regulations that make it clearer for our investors about what their responsibilities are and what it means to respect human rights. And unfortunately, efforts to ensure that this responsibility is acknowledged in legislation, is actually enforceable, is something that you can rely on. Unfortunately, that hasn't been realized yet, at least within the European Union or within the United Kingdom, and within most of the states who are party to the EU. Not all of the states. I want to give some credit here to France for actually having a mandatory human rights due diligence law that does mean that this is enforceable, and it applies to investors, not just to companies like Total. Unfortunately, most investors that are within France probably don't actually get covered by the law. They're not big enough. They don't have enough employees. But when we get to really enforcing obligations, the responsibility to respect through mandatory human rights due diligence, it will apply. It will apply to financial investors. And that's because the UN guiding principles are really meant to apply to all corporations, regardless of what kind of activities they engage in. Finance has never been a real exception to the rule. They think that they are. They have. Tyler rightfully said that there used to be this belief that there was exceptionalism about finance, and there's not. Corporations, regardless of who they are or what they do, have a responsibility to undertake human rights due diligence. That means that they are expected to figure out how their actions contribute, cause, or are linked to human rights harms. That means that they should be undertaking human rights due diligence. That means consulting with human rights defenders. It means examining the law. It means figuring out what are they doing that contributes to human rights impacts. After that, they have to figure out how to mitigate those harms. And we often talk about human rights due diligence, but I think oftentimes people forget that involves mitigation approaches. And we saw yesterday, with the Exxon example, we saw a hedge fund take seriously its responsibility to ensure a mitigation strategy so that it is not contributing to human rights harms. Once you get through that phase, then there's a question of, have you caused or contributed to violations of human rights? Have you caused and contributed to abuses? Have you caused and contributed to harms? When that happens, you owe reparations. And that's true for investors. Institutional investors can cause or contribute to human rights impacts. And when that occurs, they owe reparations. This raises a huge question about how do we know when they have caused or contributed to? Well, for me, there are 5 factors. The first is the power and the independence that they have to influence the realization of a human rights harm. That can occur both in terms of directly causing a harm, or it can occur if they simply have the power to stop their own involvement. So it could be that they are engaged in discriminatory practices in discriminatory finance, all of that can be a causing of harm, but they can also contribute to it by not asking for mitigation strategies, by not actually engaging with the companies that they engage with or invest in. You know, this is, Tyler mentioned before, the difference between passive and active investors. The reality is and I'm going to be quite blunt here, it doesn't actually matter if you're an active or passive investor. You have a responsibility to make sure that you are not causing or contributing to these harms. And that means that when you are assessing, when you are figuring out your responsibility, when you are figuring out whether or not you have contributed to the harm, you have to really figure out who are you working with, how are you working with them? And if you are contributing to a corporation who is breaching human rights, who is harming human rights, you can end up very quickly owing reparations to those who are harmed by the actions of the corporation. In addition to power and independence, then we're looking at the severity of the harm, and we're looking at the predictability of the harm. The more severe the harm, the more predictable the harm, the more likely that a financial actor is contributing to the harm, or has a responsibility to adopt mitigation, or has a responsibility to stop the investment and really work with the corporation to stop those kinds of harms. And then finally, the question is, have they adopted mitigation standards? Have they adopted efforts to limit their role in contributing to or causing a violation? And when you take all 5 of those factors together, you can really identify whether or not a corporation, any corporation, owes compensation. And when we say any corporation, we also mean all the various financial actors who work as businesses, regardless of how they structure their internal operations. That responsibility to provide reparations is complex, but it's also real. And we're starting to see the enforceability of that at the domestic level. We've talked already about the fact that ESG is a rather meaningless term and a meaningless claim. It shouldn't be, and it no longer really is. We saw with Akpabi in the United Kingdom that where companies are assuming responsibilities and they are promoting claims saying that they are doing something about the environment, about health and safety, that constitutes an assumption of responsibility. It means that you can be held accountable. Now then it was a case against Shell. Yesterday was also a case against Shell in which the Dutch government more or less said the same thing. Sorry, the Dutch court more or less said the same thing. They said that the UN guiding principles set the standard for assessing whether or not a corporation owes the responsibility to provide reparations, and owes a responsibility to adopt mitigation, and owes a responsibility to engage in human rights due diligence. They also said that, the court also said that the negative impact on profitability does not excuse the responsibility to actually live up to your human rights due diligence and actually live up to the standards of mitigation and reparations. And then finally, the court said that the responsibility extends beyond the direct impact, that it actually, Shell has a responsibility to assess and to work with their corporate group, as well as their suppliers and even their customers. That same standard, that same expectation that we have for Shell applies to the financial actors, to the large variety of financial actors that we're talking about here. It applies to all of them. And so when we're really thinking about what is our expectation here, the expectation is simple. Are you doing your due diligence? Are you having the conversations you're supposed to be having? Are you adopting the mitigation standards you're supposed to be doing? And are you paying the reparations when you're just not doing enough? So all of this expectation that we've been having, this conversation that we've been having for 20 years, where financial actors say, oh, but it's too complicated for us, or let us say ESG, that we're complying with ESG interests because that's what our customers want, or that will make us more profit. None of that's real anymore. We've now finally moved to a place where actually we're looking for accountability. And so my hope is that we'll see a case that's very similar to what we saw against Shell, but we're going to see it against a financial actor soon because they do owe this responsibility and they do owe reparations. I'm going to stop there.
Thanks so much, Tara. Incredibly important point to raise in terms of the responsibility of institutional investors, financial actors broadly, to provide or enable remedy, which is certainly something that they can do when they're directly linked, and certainly also an area where much more progress needs to happen. Touching on the point of accountability, we are now going to go to our last speaker, and then we'll open up for questions to really dig deep onto the question of investor or financial institution accountability. So Robin, over to you. Can you share with us a little bit about, the legal implications of this whole discussion for financial actors? You're muted, Robin. You're muted.
That is a very good start. Thank you, Paloma. Thank you, Claire. I am going to pick up on a lot of the points Tara has made, with which I completely agree. And I'm actually going to use the odd slide just because I think it makes it easier to follow. But I'm going to focus particularly on the legal implications for financial institutions linked with doing due diligence. And I will attempt to share screen. If it doesn't work, I will give up. And what I'd like just to focus on, and we've talked a lot about human rights due diligence and in the context of the provision of finance. And there are, as Tyler said earlier, there's a wide range of finance, but I'm going to take as my model to begin with project finance. So in a situation where a financial institution is lending itself or part of a syndicate which is lending, for many, probably for going back almost 20 years, there has been some form of human rights due diligence or some form of due diligence which would touch on human rights. In all likelihood, in a number of projects, that will identify a risk of harm, a risk of infringement of rights, and that would make that potentially foreseeable. If the transaction proceeds and is documented, in all likelihood, there will then be some form of contractual provision regulating how the project is going to be implemented. And although what I'm going to be saying is from the perspective of an English lawyer looking at the principles of the law of tort, many of the results which I'm talking about will be common to a lot of legal systems in addition to the English legal system because the principles are the same. The key point about the approach of the English courts is that they've looked at who did what, who was responsible for instigating what action, and who assumed what responsibility. They did not look at the complexities of a corporate structure. I just want to pick up on what Tyler said about the range and different types of finance. In terms of a project finance, there is usually a very direct link to a foreseeable harm. As you go through the spread of the different types of finance to ordinary working capital finance to general equity finance, the link can be much more difficult to establish. But I think it's very dangerous to speak in generalities because you can find as direct a link in some types of equity finance as you do in project finance. So in each particular type of finance, when you're applying legal principles, you need to look at the substance of exactly the relationship between the money and the risk. And for a very good example of how this might look in practice, there was what I consider to be a brilliant report written by Greenpeace in 2017 in relation to the provision of varying types of finance by HSBC linked to deforestation in Indonesia. And they set out as a model, they went through ranging from projects to underwriting and equity finance. And that brings home the point that all of these principles are applicable in a number of different types of finance. I just want to pick up very briefly on two recent English cases, and just not focusing on the detail of the cases in any way, but the most recent one is a case earlier this year where liability was imposed in relation to the breaking of a ship in Bangladesh simply through foreseeable contractual links. I'm not going to go through the facts in any detail, but other than to point out that the confusion as to how the English law of torts works was evident in the differences between the judgments of the two Court of Appeal judges. But nonetheless, they held that there was a possible liability. If you go back a few years, I don't think any English tort lawyers would have brought that case. The second type of case relates to a protest in 2015 where an English NGO assisted in a very de minimis way an American NGO in blocking fish catches in the States. And this is really alluding to the law of conspiracy or accessories. And this is, to my mind, as an English lawyer, a much underutilized area of the law. As a practicing lawyer, this was one of the areas we spent most time considering. But in this particular instance, the assistance was not material enough to give rise to an issue for the UK NGO. But if you apply this to a financial institution, what is required is basically a common purpose or a common design, and slightly less emphasis on joint intention, but a common purpose. And if you apply this principle to making finance available, you are very definitely within the range of the potential for liability if you are a finance provider. So the law is developing. It's obviously not the same in a variety of countries, but one of the key significance of the second limb of liability is jurisdictional, because jurisdiction for conspiracy is normally where the conspiracy is hatched. So it takes you straight back to closer to the home jurisdiction of the financial institution. And that is the other significance of the line of English cases, is that people who've been harmed have been able to bring cases in the English courts, which is where they are most likely to get a remedy rather than the jurisdiction of the operating company. The other comment I just wanted to make in terms of the provision of finance and the making of an investment is the responsibility doesn't stop on the making of the investment. It continues where critical decisions are made. So if there are decisions taken about exercising security, if there is interference in the way the project is implemented, then a financial actor or institution can put itself in a position where it becomes liable or potentially liable to legal action by people who've suffered abuse. One of the things I was asked to touch on was whether we can learn anything from the regulation of financial institutions, in particular in anti-money laundering and terrorism and similar areas. And my very strong view is yes, we can. I've been asked to do due diligence in very difficult jurisdictions in relation to corruption, AML, and all of these things. And when we've said to people, yes, but you also need to do due diligence in relation to human rights, they've been willing to pay for the former, but not the latter. And that's been quite a salutary experience. And as a practicing lawyer, it's simply, in my view, not possible to proceed with a mandate which is limited in that way. And we've always proceeded by doing the full due diligence, including in relation to human rights, and that's included reporting on it. One of the things which I've been most impressed about in terms of financial regulation is the way that it's developed since the late 80s and the massive leap forward it took after the financial crash in 2008. And there are a number of things you can learn from it. One is the global reach of it. So if you become implicated in corruption in any state in the world, the US, UK, and other authorities are capable of levying a fine. That it also impacts on governance. When HSBC was condemned in relation to its Mexican money laundering, it was forced to set up effectively an ethics committee as part of internal governance. And in particular, since 2008, financial institutions in the UK have been forced to introduce hierarchies of individual accountability, so that if there is a particular problem in the or infringement of a regulatory provision, you can nearly always find a particular individual who is responsible for that infringement. And so I think there are many principles in relation to financial regulation which could be taken across in setting up a regulatory regime for human rights. And if I was being cynical, I would say that I would measure the sincerity of authorities or governments in creating such a system by the gap between the financial regulatory structures and structures for regulating human rights. Do I think that doing financial due diligence makes your position better or worse as a financial institution? I think I don't think there is any option to doing it. I think the correct approach as a financial institution to properly manage your risk is to do proper financial due diligence and to follow it up with proper processes to manage or avoid the risk. I think in the past, it's been treated as a defensive exercise. It's a tick people put in a box, usually through outsourcing the exercise to a contracting firm who may be reporting it to the financial institution only via the operating or project company. And I think one of the implications of the growth of, if you like, of tort jurisdiction will be that I think that financial institutions, if they are properly advised and if they are taking the area seriously, will now have to engage in a much better, more thought through process, which starts with initial financial due diligence, goes on to management of the risks, and looks at it throughout the life of the particular financing. Mm-hmm. On that note, I will hand back to you, Paloma.
Fantastic, Robin. Thank you so much. This is such an incredibly important discussion, and I think it relates, of course, to certainly what everyone has shared with us today, but some of the questions that have come up. So we have, about 20 minutes left, and so I'd really like to transition now to take questions from the audience. As Tara very kindly highlighted, please do share your questions via the Q&A box. We already have some questions there, so we can start with those, but please feel free to share more. So I am going to now just read out a couple of the ones that we have and see, who might be interested in responding to those. So the first one is essentially about why has robust financial regulation regarding human rights due diligence been so challenging to make progress on? Right. And so I think the comparison has been, around governments able and willing to, lock, boycott, freeze assets of countries or individuals in certain countries over human rights issues. But they've been much more reticent to regulate financial actors with regard to their own human rights responsibilities. So that's one. And then there's another question that is very specific to the UK. So do any of the panelists have any thoughts on the Social Value Act of the UK and how that might be able to be a force to advance some of the objectives that we seek to achieve through sustainable finance? Phil, over to you.
Thanks, Paloma. I mean, just on that issue of the social, God, I can't remember its name. What's it called? The Social Act.
The Social Value Act.
Social Value Act. Thank you very much. I mean, there's been a lot of effort. There was a quite strong public procurement act passed in the 2000s, but that was got rid of. And it was having some impact in terms of the state's public procurement of services and products. The Social Value Act was brought in, and to my understanding at least, and we've tried to track some of this, it's been very, very hard to ensure that it has any real teeth. And so from a public procurement point of view, I think what we need across the piece is particularly, for financial services, but across the whole area of human rights, we need much stronger public procurement provisions to make sure that we can do this. I mean, the most obvious one is the one that I know best, which is the Modern Slavery Act. The British made a very big piece about the Modern Slavery Act, which actually, again, financial institutions played a really positive role in insisting not only that there was an act, but that there was a transparency in supply chains part to that act, and that it should apply to all actors, including the financial markets, but also to those international companies that wanted action in the UK market. But when the government when the government actually instituted the Act, it fails on every single account to ensure that its own procurement of services and products is exclusively from companies that even have a statement, a minimum statement on modern slavery, which is the legal duty of those companies. So even in its public procurement on an issue so egregious as modern slavery, it does not insist that it has not insisted that companies can only provide those services and products, including financial services and products, if they have even the minimum modern slavery act statement, i.e. compliance with the act itself.
Perfect, thank you. And I see Tyler, you have your hand up.
Yeah, I mean, I think notwithstanding the specifics of the Social Value Act in the UK itself, I think the point is an important one, that governments are the largest buyers of goods and services worldwide, without a doubt. I mean, there's no company that even compares to the amount of goods and services. So if we're thinking of finance as a lever to drive change, no doubt government procurement is a massive lever to drive change. So I think, them living in and exemplifying the standards that they expect and of their businesses is a key aspect. At the OECD, in fact, since last year, we launched a process bringing together 50 public procurement agencies to try to streamline. We actually have a legal instrument on integrity in public procurement at the OECD that primarily relates to the integrity of the procurement process to avoid, undue influence, conflict of interest, corruption. Still major challenges, by the way, but doesn't really relate to the quality or the human rights, environmental performance of the services that or goods they're procuring. We're moving now to looking at revising that recommendation, but now we've done it through a process where we brought 50 procurement agencies together. And what we see is actually, in some cases, some of the procurement is very well developed. I would say, in comparison to how businesses and retailers in particular, some retailers are doing. But they face a lot of the same challenges about how do I go beyond tier 1? Do I have to rely on certification initiatives? How do I get the data that's necessary? But I do think that's a bit of a big opportunity for governments to align and commit themselves, because their collective leverage to drive those change would be perhaps more significant than many of the businesses in their jurisdiction.
Fantastic, thank you. I wonder if there's any other sort of reflections or comments from panelists. I don't think we've received any further questions in the QA box. Okay, perfect.
I mean, Paloma, I can actually address the other questions that were raised in terms of why does the EU, UK, and US, why are they willing to block and boycott or freeze assets with countries that they disagree with, but not sign on to the treaties and protocols, and what does that mean for the financial actors? At least I think that's how I'm interpreting the question. And I'm going to be really, I don't know, skeptical here and say that the reason that they are willing to block and boycott and freeze assets of countries they disagree with is because they're not actually acting out of their human rights responsibilities or obligations, right? They're acting in compliance with their political interests and needs. That's a fundamentally different thing. We have not seen the EU, the UK, or the US really pursue the kinds of legal expectations and responsibilities that they promise and pledge to follow when it comes to adopting regulation about corporate responsibility or corporate human rights due diligence. And it is true that the US doesn't sign on to half the treaties that it now expects other countries to follow. That's partially the reality of the US internal political situation. For the US to ratify a treaty, it has to go through the Senate, and The Senate right now has a significant Republican presence with absolutely no interest in ratifying something like the International Covenant on Economic, Social, and Cultural Rights. So you have to be looking in the US for how you can do alternative advancement of human rights than through treaty ratification. When it comes to the financial actors and why that doesn't align with the expectations that we provide for other states, I think some of that is legitimate and some of it's simply not. The reason that it's legitimate is our traditional obligations for human rights are with states, right? States do have existing obligations to respect, protect, and fulfill human rights. Corporations have newer obligations or responsibilities to respect human rights. And so asking countries and governments to abide by human rights obligations and to hold them accountable when they fail to do so, that's a legitimate situation. I don't think that we need to have corporations held to the same standard that we have states held to. The illegitimate part is, again, the reason that you see these blocking and boycotts and freezing of assets is really about the political advantage that the EU, the UK, or the US gains, or at least the absence of political harm, right? So they can hold Myanmar accountable. They can sort of almost kind of hold China accountable. They can sometimes occasionally hold Russia accountable and Belarus. And then anybody else, anyone that has an actual significant economic relationship with them, they're never going to do it. Or at least they've never shown themselves willing to do it. So I think that that's just part of the reality. And I think the response to that is to try to hold them accountable via court cases, via challenges, but don't expect much more than that. The other question is, sorry, do you want me to stop talking, Paloma?
No, unless anybody else wants to jump in. Nope. All right.
Okay. The other question is CSR regulated around the world, or is it just a set of statements from corporations around charitable actions? This is the difference between CSR and BHR, right? Business and human rights has more than just charitable actions. Anybody who tries to make CSR or BHR, I think, does a real disservice to business and human rights. I think it does a real disservice to what the expectations are. Right now, yeah, we don't have a significant amount of legislation anywhere in the world to cover business and human rights or CSR. But I think the expectation is there, the state responsibility to do it is there, and we are increasingly seeing courts respond to the demands of business and human rights, whether that's, again, the UK with the case against Shell. Almost all the cases involve Shell. So thanks to Shell for being absolutely horrible at business and human rights, because you have given us a foundation legally to point out how horrible you are and what other businesses should be doing. The UK government, the court system, has recognized that these commitments to CSR, these claims of being responsible businesses, actually give rise to a responsibility to abide by those claims. And now we've seen the same thing with the Dutch case. If you look at the Dutch decision from yesterday, and I'm gonna own up here that I've read the decision once, I need to read it about another 6 times before I really fully am gonna comment on the case. But the first thing that the court notes when it comes to assessing the legal obligation of Shell is that Shell endorses the UN guiding principles and claims to believe in the UN guiding principles. They're not alone in that reality. The UN guiding principles were universally endorsed by states, and they were widely embraced by corporations. They were a concession by NGOs, right? The NGOs were actually the ones who were disappointed by the UN guiding principles because they didn't go far enough. But the states and the corporations embraced them. That corporate commitment, that corporate claim of wanting to abide by the guiding principles, that's an assumption of responsibility. And that influenced significantly the court's decision yesterday. So while we are still not seeing the legislative advancement that we should, we are getting a little bit, there are reporting requirements that I generally find rather useless, but at least it's somewhat of an advance. You have the French duty of vigilance law. You have the Dutch child labor law. and you have a proposal for a German mandatory human rights due diligence standard. Those legislations are coming, but they're not where we're seeing leadership. Where we're seeing leadership is actually within courts who are saying that they recognize that there has been an assumption of responsibility, that corporations do owe something more than what they have wanted to, and that their responsibility, their
Uh-oh, Sarah froze. Okay, we have about 5 minutes left. So what I'm gonna do is just very briefly ask Phil, then Tyler to give sort of their final remarks, as I know both of you want to say a few words. 1 minute each, and then we're going to hand over to Anna to close us off. Over to you, Phil.
Yeah, no, I just wanted to build just a moment on Tara's remarks, just to say, you know, the CSR is what companies do with the money that they've made. And business and human rights is concerned about how businesses make their money. So it's a fundamental difference. And in terms of finance, there's lots of financial institutions that have their own corporations, their own philanthropic arms. But that's a lot to do with marketing, a lot to do with risk mitigation, and some genuine philanthropy. But that's very different to the model of finance, to the due diligence efforts, the remedy mechanisms, the grievance mechanisms that they need in order to ensure that they live up to the UN guiding principles and avoid the exceptionalism that we've been speaking about. I just wanted to make that point.
And a very excellent point. It was so brief that we can give Celine 1 minute to just add in final comments. I noted that you wanted to say something, and then Tyler, and then we wrap up.
Hi, thank you for allowing me to just say something. I just wanted to just remind everybody that actually, you know, we need to really question the fact that the issue of whether financial markets are a sustainable and stable way of financing these transitions, okay? And no matter how good, you know, business and human rights standards are, how good CSR standards are, I think the ultimate issue isn't about that. There are sticking plasters if we don't sort out the international financial architecture and the regulatory framework in which these financial markets operate under.
Fantastic. Thank you, Celine. Tyler, over to you.
A bit of a broader point to end on, that this topic of sustainable finance is truly multidisciplinary. And I think, you know, within this panel, you have a really fresh and a pretty progressive view of where we need to go. But we have to remember that we have ministries of finance that have been working in finance for years and are not as involved in these discussions. So, you know, we really need to focus on bridging those policy and sort of silos between governments and amongst experts. I think we need to be able to bring in friendly skeptics who have different views and listen, because, you know, and I know at the OECD, it's a major issue, because you have the Monday OECD, which is all about free markets and free trade and open investment environments and stable financial markets. And you have the Tuesday OECD that's all about development and responsible business conduct, and, you know, never the twain shall meet. But we are doing a lot to try to bring those policy communities together. So my only kind of leaving words for all of you is to talk to somebody that disagrees with you but is open to a discussion, and really think about this, because this is the train's leaving the station at the G20. They're restarting the Sustainable Finance Working Group. FSB, the Financial Stability Board, is having a Sustainable Finance Working Group. IFRS is going to starting a Sustainable Standards Board. IFRS is a bunch of accountants, and at the G20 and FSB, those are finance people. And I'm not sure we want them defining what human rights outcomes look like, but we also have to listen to them. We also have to listen to what they know about their sector and their policy drivers and what they need in order to deliver their policy outcomes. So leave it at that. Thank you very much.
Those are perfect concluding thoughts, Tyler. Thank you so much. And thanks to everyone for joining us today for what has been, I think, a really sort of, as you said, progressive conversation as to how we need to drive sustainable finance in the coming decade, which, as I mentioned at the beginning, is certainly a priority for the UN Working Group. So my final note is to say that on June 17th, the UN Working Group will be publishing the report on sort of the implementation of the UN guiding principles among institutional investors over the past decade, with recommendations to improve institutional investment in the coming decade. So look out for that report on June 17th on the Working Group's website. And yeah, once again, thanks so much for joining this conversation. Over to you, Anna.
Well, I hope that all of you have found this session as rich, as insightful as I have. And again, I would like to thank you to our invited guests for joining us today. Please be sure to join us for the next episode of this series, which will be held on 24th of June, as usual at 2 p.m. to 4 p.m. in Lisbon time. The topic will be corporate due diligence and gender equality. Finally, before you go, if you enjoyed today's section and today's panel, we invite you to follow the work of the Nova Center on Business, Human Rights and the Environment on social media. I invite you to listen to our podcast and to sign up for our newsletter. It has been an honor and a pleasure. So until next time.